What is wealth? Throughout the series we'll be running a brief segment on what is wealth. It compares Fred and John's financial affairs, so to help us see if we can determine what an accurate definition of wealth might be. I think you might be surprised. Let's recap Fred and John's position so that we can have a look at how well their debt is structured. You'll recall that Fred lives in his own house in the wrong side of the city, valued at $570,000. He drives a 2002 Ford wagon, which he keeps reasonably neat. He has an investment property in a good suburb, but on the wrong side of the city still. He works in IT. His income is about $90,000 a year. And Fred develops software in his spare time. John alternatively lives in his own house in the best side of the city, and that's valued at $1.5 million. He drives a brand new Porsche. He has an investment property in a dress circle suburb, again on the right side of the city. John works as an investment banker, earning $418,000 a year. And of course, John parties in his spare time. Let's have a look at their debt. In terms of non-deductible debt, Fred doesn't have any. He's paid off the debt on his principal residence. John, however, when he bought his investment property, restructured his loan. His experience allowed him to get the best structure, so he has an 80% loan to value ratio on his principal residence, so that means all up he owes about $1.2 million. By structuring his loans in this way, it allowed him to have a 100% loan on the investment property. Deductible debt. John has a better tax structure because, as we mentioned, he owes 100% on his investment property. John says on his salary he badly needs deductions. Fred has paid down some of the debt on his investment property, so he only owes about $195,000. Welcome back. We're with Gemma, who is going to help us with a reverse interview on risk. Thank you for joining us, Gemma. What would you like to know?
Well, the stuff on insurance looks pretty good, but how do the insurance companies know what to charge?
Okay. They work charging off tables. Back in the 18th century, a bloke called Halley, you know Halley of Halley's Comets?
Oh, okay. Yeah.
Not only did he discover comets, he discovered insurance actuarial tables. So he did statistics in London that said that, for example, a female of age 26, of that group of people, 3 would die this year. And from those figures, the insurance companies are able to know, okay, a man who's 26 or a man who's 34, how many of those people will die and consequently how much they can charge them. So this base rate is fine. Then they use actuaries to have a look at how many of those people they've insured. So if they've insured none of them, they use a reinsurer so that they balance their risk. If they've got a lot of them, they know what their risk is, and that's how the insurance premium is calculated.
So what happens if you've got asthma? Does that table you're talking about still apply?
Yes, it does, because the table includes everybody. But if you've got asthma, you've got your own table. You're really lucky, but it normally implies you pay more. So everyone with asthma has their own table, and it depends on how severe the asthma is as to how much you might pay more for that premium. So someone with mild asthma, you know, maybe just takes a puff every now and then in the allergy season, probably would be rated standard. But somebody who is severely affected by asthma have their own rate, and the insurance companies deliver what's uncommonly and unkindly called a loading. It's not a loading, it's an actual true premium for your condition.
Okay, so now I know how the insurance companies set their premiums, but why would I choose to get insurance?
Okay, that's a good question, Gemma, thank you. The insurance, someone deciding to buy insurance weighs consequence. So they say, this is the insured event. If it happens, it's going to cost me a lot of money and it's likely to happen. So that's an insured event. Maybe I'll make it a little bit more simple. So if you had a trampoline, for example, and you wanted to insure it in case it got wet in the rain, that would be an uninsurable event. Why? Because it probably wouldn't get damaged if it was rained on. 2, if it was damaged, the cost of repairing it might be about the same price as the cost of replacing it, and both of those would probably be cheaper than the insurance premium. So that's an example of low consequence, low probability. Whereas a high consequence, higher probability might be, I don't know, getting hit by a flaming oil truck. It's my way of talking about death. Right? So if somebody was to consider life insurance an important part of their financial affairs and took life insurance, they would do so because the consequences to their family, should they die, are extreme. The likelihood of dying is not very large. So you can see we've got a balance between consequence and likelihood. And it's that balance which might make you decide that insurance is pertinent in your affairs.
Okay, so I'm single. Do I need life insurance?
Okay, so let's go back to that consequence probability thing again. So the consequence of death is still the same. It's going to leave untidy ends. But you're not leaving untidy ends for people for whom you have a financial responsibility. It might be nice to have a bit of life insurance so your parents are not disadvantaged when they come to plant you, but it really is probably not necessary for a person who's single to have life insurance.
Okay, so I'm working full time. Do I need income protection?
Yes, you do, Gemma. The thing that you must, I've said a number of times, if you had a goose that laid a golden egg, would you insure the goose or the egg?
The goose.
Okay, that's the correct answer, because you're insuring the component that earns the money. If you insure the egg and the egg's lost, tough. You've still got a goose that lays golden eggs. And in this case, as you're working full time, you're the goose. No, you're not really a goose, but you're the person who's earning the income. And if you protect income, you protect everything about your lifestyle.
Okay, so what you're saying then is that everyone needs insurance, but it's got to suit them individually.
That's exactly the situation. So at different points in your life, different types of insurance are appropriate. As soon as you earn money, income protection is appropriate. As soon as you recognise that you'd have a financial loss due to a traumatic illness, that would be necessary, although we'll cover those things more fully in another program. Life insurance, as soon as you have a dependent who relies upon you, or debt, again, that's important. And total and permanent disability goes with that also. Gemma, look, really thank you very much for helping us with this reverse interview. You've asked some really insightful questions, and I hope the viewers feel you've represented them well. Thank you for joining us. Thank you for joining us. That's the end of this episode of Wealth Plan TV. We'll see you next week. Don't forget our competition. Please go to the website and sign up for our 100 Gold Challenge. Prizes are being generously awarded by AIA Australia, who are giving a free risk assessment away every week, and 2 iPads to be won throughout the series. And also Keith Abraham, who's donated his book about finding your passion. Go to the website wealthplan.tv. Thank you for joining us on Wealth Plan TV. I hope you enjoyed the show. Next week, we'll be dealing with risk.